Alrighty, so we're getting down to the last class on the Iron Condor, and before we finish, I hope that you've been able to pick up some new trading tips and have gained some insight from my experience with this particular trade and studying options in the Greeks for such a long time. And I know everybody has a different perspective on the trade, and I have mine. And so hopefully I've been able to help you in some way through watching this video series. And so the last thing we're going to talk about are some of the possible adjustments if you do choose to take on this task of trading the Iron Condor. In the previous lesson I did point out the risk, and I showed you how the theta is it's there, but it's not really a very strong component in the trade. And when this market really moves around, it can't possibly override the effects of the delta or the vega. So, being aware of that, then make sure that you understand those risks entirely before you actually dive into this type of strategy. But we'll talk about, we've alluded to this earlier in the class, but we'll talk about some of these adjustment possibilities. And so I'll draw a couple up here for you. All right, so let's say, again, I have my my own comfort zone, where I feel comfortable. It would be somewhere in that range. I don't like to be in a trade where I'm actually losing more than I could possibly make. So once I'm within a range where I could actually lose 10%, which would be kind of like this point, but that means, if I can lose 10% at this 970, that means the 950, I'm already within the range, because the Russell can move 10 to 20 points easily in a day. So you have to be aware. So if I get to this point here, I'm already kind of on guard, because I know that within one day I could be to my 10% loss. Okay, and so when I start to get into that zone, which is going to be the uncomfortable zone, so you have your comfort zone and your uncomfortable zone, then you have to start to consider some adjustments. Okay, now for the call side, what happens to the Russell, at least normally, I think the statistics show it's like over 80% correlation. So as the Russell goes up, I'll just use an up arrow, then volatility, or the RVX, drops. It's, again, somewhere I read statistically it's over 80% of the time. Okay, so that means that this side, we have some hedging going on here. We're a little bit benefited from the negative Vega position. Okay, so when we do an adjustment on this side, then be aware of the Vega position that you have, and how your adjustments may change your Vega position. You also have to think about your buying power effect. Okay, so again, if you start the trade large, like if you're all in from the beginning, then most likely you'll have to start to buy back this side. So let's say you started with 10 contracts, you might buy back 2 and start to change it so it looks kind of like this, and morphing that trade into an unbalanced condor. And then as you pick the side up, it'll help flatten this out. So currently you have this kind of slope, and then when you buy a couple of those back, it'll get flatter, and you can sort of change the location of your frown. So now you're back at the top of the center of the frown there. But then you can get whipsawed, so if it goes back, you can start to lose. And and so on. So again, it's not like an easy trade by all means. So these are things to think about. With the call side, at least you have the Vega, the negative Vega position. It helps you a little bit. But one thing to note, coming down here, notice as you move to the right, your negative Vega is actually, it's decaying on you. It's changing. Again, I don't want to confuse you with all of the second order Greeks, but this has to do with your Vanna, and we'll get more into detail into our course. But this is your Vanna position to where you're going this way, and all of a sudden your Vega on this is actually becoming more positive. And that's not good for the trade, because it again, as I pointed out over here, as the Russell goes up, then your volatility drops. So we really benefit from having negative Vega, but the Vanna positioning in the trade is actually changing the Vega to a negative, to a little bit more positive number, because it's starting at negative 216 and then it's going to a negative 64. So the Vanna position in the Condor on the call side doesn't help the position, it hurts it. Okay. So be aware of that. It's way too complex to get into how to adjust your Vanna and all that in this series. But just be aware, it's just something I wanted to point out. Okay. And so again, if we're to close out some of these, it's going to take what kind of trade? Well, if you're starting off, you have a credit spread over here, you're going to actually have to buy in some debit spreads. Okay. And so when we do that, let's take a look at how that's going to affect the trade. So I'll come down here and I'll adjust that, let's say, to 5. And then we'll look at the graph again. So that's, again, theoretically, hypothetically, let's say we're over here. And so we do that adjustment. And now notice our Vega position just dropped. In a way it rose, but it was negative 60 something and now it's negative 40 something. So you notice as you go this way and you buy those debit spreads or take off the credits, that it's actually helping your delta position over here, making it a little bit more flat, but it's at the same time it's also taking away your Vega hedge. So it's something to be aware of. So the more that you kind of chop that down, you chop this down or you take it off, you're hurting your volatility hedge on the call side, but you're helping the delta. Okay, but that's a very common adjustment, and it's in this class. It's as far as we're going to get. I'll just tell you, I'm giving you insights so you can experiment on your own and try to figure out better ways. The pros to that is it's definitely helping your delta. Okay, so you're getting this flatter. Again, we're talking like if we move over here, we're starting to get out of our comfort zone. So we're getting a little bit better delta position. We still may have a little bit of credit here at the top, but we're giving some back. And at the same time, it's hurting your Vega position a little bit because, again, as I already told you, the RVX is going to drop about 80% of the time. And so the trade really benefits to have that negative Vega over there, but you're starting to actually lose some of that hedge. So it helps the delta, but it hurts the Vega. But overall, it's you're taking off the risk. So you're taking off some of the risk over here as it moves that way, and that's a very simple adjustment process that you can really consider. So now let's talk about the other side of the trade. And of course you could do the same thing on that side. So let's first look at the same adjustment. Okay. So here's a similar adjustment here, and you can see same type of thing as you're getting in this area. You can start to take off the risk by buying back those credits and raising this side of the graph. So when you do that, it's going to lower this part down, so you're going to lose a little bit of your initial credit, but at the same time, at least this way, because remember the discussion about the volatility here, you have a little bit of a benefit on this side. So you have your puts over here, and again, as the Russell, and it'll be similar for the SPX and the NDX or IWM SPY diamonds, as they go down, so Russell drops, then there's an extremely high correlation that the IV or the RVX or the VIX, whatever, is going to rise. It's actually 100% correlation if it's a pretty large move. So if it's like a 2% move in one day or 3%, something like that, it's like pretty much always, it's really close to 100%. Any large move, it's definitely 100%, but I'm not sure what the threshold is. Okay, so as we go this way, then it definitely behooves us to raise up our Vega to have a little bit more positive Vega and get rid of that negative Vega. So when you buy back the credits, you're actually placing an order for a debit spread. Okay, then it can help your Vega position, and in this case it's okay. It doesn't hurt your Vega position like it does on the call side because of the directional, the inverse relationship between the Russell and the volatility. So that's how you can work on the put side. And again, if it continues down this way, you need to find your comfort zone. So, you know, and then you can just keep chopping it down or taking it off. And then if you go back this way, well, you can always put them back down. But as you're making all those adjustments, you're usually losing some money and you're moving the bar down lower and lower. And that's typically what happens with this trade. I'll show you one other simple adjustment that will help you increase the Vega a little bit more. So another thing you could do on the put side is you can buy some of the, you can, instead of doing the whole debit spread, you could actually just buy some long contracts. So let's look at maybe buying one extra put here, and then we can look at the the difference. So notice in this situation, and let's look at maybe two. So we showed the graph on the other one, but let's look at this one for a moment. Okay. So notice this one, if you just buy some of these extra puts, like out of the money, you can always buy the inside, but if you buy the outside, you're adding some more positive VAMA. So notice if you do this, then your leg here is starting to actually go up instead of flat like it is on this side. And then you're creating an immediate risk curve that actually starts to curve up. And so you see the difference there between, you know, just buying some extra puts instead of the whole debit spread. Okay, so it's a little different reaction that you can have, but also notice how it affects the Vega a little bit better. Okay, so the other one, you can keep holding on to your theta a little bit stronger, but this adjustment, it can actually shift your Vega, as you see, to actually positive. Okay, and so depending on the market, like when you're in a low volatility market like today, and we're in March of 2013, so when the vols are so low, this could be a decent type of adjustment compared to the debit spread, because you're getting, you're starting to create yourself a back ratio spread over here, and there's just a higher chance right now that volatility could go up. So this would be an adjustment that would be more protective in nature and giving away some of the theta, but going after a little bit more of the protection to the downside. So that's definitely another alternative. For the call side, I mean, you could do a similar thing, but you would be adding a lot of the positive Vega to the call side. So that's why I was pretty much just showing the credit or the debit spread on the call side. So that's about it for now. I hope you were able to pick up some new insight in trading the Iron Condor. If you do trade this, then I definitely wish you a lot of luck. It's a pretty tough trade. Sometimes it works out really nicely and everything's great, but it seems like by the time you get comfortable with it, then you find yourself kind of glued to the computer, and then you get to the point where you want to learn something different, and that's really what I went through. So I tried the strategy for a few years, and then I just kind of outgrew it, and I developed the newer strategies that we teach in our course that really help free up my time and allow me to focus on actually developing the software and things like that, so I don't have to monitor all my positions all day long. But I mean, this is a great conversation and an excellent trade to learn from, to practice. Certainly recommend to paper trade it. I can't really recommend to do the trade, with real money. But still, great conversation, and there's so much to learn from this trade, and so highly recommend, paper trading it, trying out some of the knowledge you've learned in these lessons, doing some back testing, and see if you can, further your knowledge on this particular spread as well as others. So thank you very much for watching that video series, and I guess I'll be signing off. So this is Morris with San Jose Options, and thanks once again.